Today we're going to discuss a trade that I recently made, and I will also share my opinion on software stocks that are currently beaten down, as many investors are looking for value there, and I receive a lot of questions on why the stocks are dropping and what the catalyst could be for a potential turnaround. I'll share my take on that later in this video. Last week I sold my applied materials stocks and I used the funds to buy Meta. This is the first time I've sold a stock since the beginning of 2025 when I sold Apple to buy Amazon. As you can see, my portfolio have already reached $50,000. I've been building this portfolio for 2 years and I believe it's doing pretty well. Let's look at why I've bought applied materials in the first place. I've opened it here in StockPicker. As you can see, we have developed an AI analysis tool that is here to answer some of the most important questions an investor should ask. My name is Kostadin Madarov. I'm a retail investor and the founder of stockpicker.tech, the best stock research terminal for retail investors. You can try it now for free. No credit card is required. I'm sure you will enjoy it. So let's look at what the company actually does. Applied Material is a semiconductor company. They're like the essential toolkit provider for the digital world. They design, make, and sell the highly specialized equipment and software that chip makers and display manufacturers need to create the advanced semiconductors and screens found in everything from your smartphone to powerful AI servers. So think of them as the supplier of the foundries like Taiwan Semiconductor, Intel, or Samsung. These are their biggest customers. Now, their business is primarily divided into three main areas: semiconductor systems, applied global services, and corporate and reconciling items. Now, obviously, the semiconductor systems are their biggest revenue stream, with more than 73% of their revenue coming from there. Now, I'm going to scroll down here in this AI analysis. We have outlined the metrics that and the fundamentals that matter the most for each company. So, for Applied Materials, a company at the heart of semiconductor manufacturing, these 3 to 5 metrics are key to understanding its financial health. So we start with the revenue, then we have gross margin, operating cash flow, R&D expenses, and EPS. I would say at this current stage, revenue and gross margin are the most important parameters because the revenue shows what percentage of the AI spending frenzy they are capturing, and the gross margin is showing if they're competitive enough and they can increase prices. So these are the two most important parameters I would look at. I'm going to scroll down. The revenue has been growing, but the forecast is that it's likely to go much more. Look at it. So in the last quarter, they did $7.01 billion. And in few years, in Q3 2028, that's 2 years from here, it is projected to do almost 11 billion. So it's like projected revenue of 50%, which looks amazing. But in the last 1 year, their revenue growth was only 4%. Now, if we look at the gross margin here, we can see that it's steadily increasing. This shows pricing power. And generally, this is a company this is like the closest to ASML. It's a great company with very high competitive advantage and wide moat. Now, we're going back to the context here, where it will tell us that the most relevant valuation metric is the PE ratio. Okay? Why it's good for Applied Materials? Applied Materials is a well-established, profitable company in a cyclical but growing industry. Now, PE ratio sometimes can be confusing depending on the company, but I agree that here PE ratio is one of the metrics that is important, and we can see that in the last year it moved from 16 in the end of March and beginning of April 2025, it moved up to more than 40. And yeah, I bought the stock at price of $173 per share, and I sold it at 398. That's, I would say, a very good gain. And I will explain to you now why I sold it. If you've watched this far, it means my content is valuable to you. That means a lot to me, and I would greatly appreciate it if you subscribe to my channel. I sold the stock because of several reasons. The first and most important reason is that I want to reduce my exposure to the semiconductor industry. It is quite cyclical, and I already have exposure there through ASML, NVIDIA, and Credo technology. The whole industry is dependent on hyperscaler spending, and if that spending cools down, we can expect big issues in the semiconductor industry. Also, it's priced for perfection. I've already mentioned the PE ratio, but also price to sales is 11x, which is almost 3 times more than the median for the last 5 years. I think that is a bit expensive for a company that grew revenue 4% last year. My original idea was more of a swing trade of a high quality company. I held it for over a year and I thought it was a good time to switch to higher growth stocks. Now let's look at Meta. The most important metrics here are revenue, net income, R&D expenses, operating cash flow, and CAPEX. Their revenue grew 22% last year and it is projected to double by 2030. However, sentiment is currently a bit negative due to the heavy CAPEX on data centers. Personally, I believe this is one of the most resilient businesses in the world, and I'm taking this opportunity to buy a high growth business at a reasonable price. I actually covered Meta in my previous video as one of the 5 stocks I've been buying for 2026. I strongly recommend checking that out. I'll leave a link in the description. Moving on, let's discuss the drop in software stocks. Many investors are looking for value there, including YouTubers like Avioeconomics, who recently invested in Adobe. Let's see what he has to say about it.
Purchase number 3, I called it. Whatever the reason, if the stock crashes under 300 or ideally under 280, I will buy Adobe. Now that the price is actually in my buying area, should I get scared? No, I think 450 for Adobe is the bare minimum reasonable price.
I respect Adri and enjoy his videos, but I have a more balanced take on Adobe and the software industry in general. Let's open the data in StockPicker. The fundamentals seem flawless. Revenue is showing steady linear growth and gross margins are close to 90%. At the same time, however, the stock is down 30% year to date. PE ratio has dropped from 42x to 13x. Why are investors only willing to pay a third of the previous price for a company growing this fast? In one word, uncertainty. Obviously, coding has become cheaper. Tools like Claude, Cursor AI, and Codex have significantly improved efficiency, making it much less expensive to build software. This is putting Adobe's pricing power under pressure. I'm not implying that a teenager in a garage will disrupt Adobe or Salesforce. That is unlikely. But when coding is cheaper and faster, established companies begin entering each other's market. Canva might close the gap, or Apple might, or perhaps Microsoft will develop a good enough tool to bundle for their cloud customers. We don't know yet, and that is the biggest issue. Investors love predictability. They aren't just selling Adobe, they're selling the entire SaaS industry. Salesforce, ServiceNow, and SAP have all dropped significantly in the trailing 12 months. These companies are shifting their business models from seed based to consumption based, which brings even more uncertainty. Maybe they will pull it off, and maybe they won't. That is what we need to see. Will they increase prices? Will revenue continue to grow? Will margins stay high? will the stock re-rate back to a 40x PE ratio? Once we have clear answers to these questions, we will see a relevant re-rating. The next step would be to watch this video that would be very valuable to you. Thank you for watching. See you next time.